Nilesh, how do you prepare for the worst? And what could that worst be? Because like you said, for now, we're already grappling with that 50% tariff. And, clearly a lot of concerns around exporters, textile, leather goods, etc., etc. From a market standpoint, what could the worst be? Because here's an index alone, which is now into a sixth consecutive week of decline. We've had a rough patch with the FIs selling India all through the month of July, and it hasn't got any better. In fact, on the index alone, we've seen a 5% decline.
Aisha, as Peshwa Bajirao mentioned, strike at the root of the tree and branches will fall. Let's focus on economy. Markets will take care of itself. FPIs also will be taken care by focusing on economy. In economy, we have to ensure that we leverage the second largest trade deficit in the world of more than $250 billion plus to ensure that we can divert our exports from goods where America is levying tariff to other countries. And when you run $250 billion plus deficit, it should be possible. Second, we are also one of the largest spender of travel and education. 1.7 million Indians traveled to America. 2.6 crore people traveled abroad. We need to leverage our spending on travel, on education, on goods deficit, on giving access to American companies in Indian market for opening up markets for our exports. The second, obviously, is to stimulate our domestic economy. The government has taken steps through income tax cuts. There is potential GST rationalization as well as petrol diesel price cut probably on the anvil. There is 8th pay commission and there is also reduction in interest rate. Now we must accelerate ease of doing business so that domestic economy is stimulated. And yesterday, as Prime Minister mentioned in Bangalore, we must focus on creating independence in technology. Today, we are dependent on the world for R&D and innovation. We must ensure that we become Atmanirbhar in R&D and in technology. It's not going to happen in a hurry, but we must have a roadmap. If we take care of economy, which is the root cause of everything, then markets and FPIs will be taken care on its own.
Good morning, Mr. Shah. This is Shrishti also joining in. But in the long run, Mr. Shah, it will only be earnings that is expected to drive the stock performance to be backed by the growth of the economy and maybe outperforming that. As we are at the fag end of the earnings, if you can help us analyze that, which are some of the sectors where you believe that the outperformance continues or likely they are expected to outperform the rest of the sectors, your sector bets as of now?
So, Shrishti, while conventional wisdom do suggest that stocks are slave of earning power, but do remember that returns are also based on valuation. You could see 100% earnings growth and valuation derating, generating no return. So we must ensure that not only our earnings grow, but our premium valuation, which is one of the highest in emerging market, continues to sustain. If earnings grow and valuation get derated, then there will be no return for investors. At this point of time, the June 25 quarterly results is more or less in line with the expectation. Of course, from double-digit earnings growth, it has come down to high single-digit. But 7-8% earnings growth is not bad. Within overall earnings growth for the market, there are sectors which have done well. There are sectors which have disappointed. But FY26 is year of consolidation. We should be looking at earnings of Nifty EPS somewhere around 1100 to 1125 rupees. Can the second half, thanks to monsoon and consumption boost, revive? As of today, we haven't heard that in commentary from corporates, but who knows, festival season can bring the cheer. The focus will be on FY27 earnings. Can that move into double digit? And a lot will depend upon how the situation evolves.